It was a tough day in the stock market with the S&P 500 down about 1.5%. We did close a little bit off the lows today, but when you tack on that 1.5% on top of the 1.63% sell-off we had on Thursday and a couple of the other 1% types of days that we've had since the middle of September, all of a sudden we've seen some pretty violent action within the market. There are many sectors we'll talk about tonight that are at 3-month lows right now. In fact, the S&P 500 itself is at a 3-month low. There are several sectors that have oversold cluster signals, so we'll talk about that. Really, energy is the only one that has any semblance of kind of strength here at the moment. It's tough sledding out there. It's not just the United States either. With the US dollar continuing to go up, many foreign countries are struggling at this moment with their markets as well. Of course, we're also going to have a conversation in tonight's video about the ever-increasing interest rate environment and how much pressure that's applying to a lot of the dividend-oriented areas. And then we'll get into our trade application example, where I did want to focus on a dividend king that has been very much out of favor here for the last couple of years, and is now to the point of not just giving us oversold cluster signals on a weekly candle chart, but also on a monthly candle chart. And I'll show you how to do a sold put trade idea that could theoretically set you up for the highest dividend yield that that stock has ever paid. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 26th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. Also remember, at the bottom of those emails, you'll see which stocks in the S&P 500 have overbought and oversold cluster signals in them. And with today's massive sell-off, I will bet we will have a lot of oversold cluster signals. In addition to that, we're heavy users of X, formerly known as Twitter. Make sure you're following me if you're not doing so already. My handle is @BrandonVanZ, and we really appreciate those of you that click like on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And let me go ahead and find our heat map here. So again, this is coming from FinViz, so this one's a little bit different than the one that you guys will see me use from Thinkorswim. Each of them has kind of their own unique features, but they kind of drive towards identifying the same types of things, mostly through an interesting visual to see what kind of a day it was in the market. And if you looked at your portfolio today, you probably didn't have any questions about that topic. Nonetheless, let's see what we can learn here. As you can see, it was an overwhelming sell-off day on Wall Street. We've had a couple of those here within the last week, but today's stock that catches my eye the most, at least immediately, is Amazon. It was down 4% today. We found from the other Magnificent Seven companies, Apple was down 2.3%. Google was down nearly 2%. We had Microsoft down 1.7%. We had Tesla down 1.16%. We had Nvidia down 0.74%, and then the final of the Magnificent Seven is Meta down 0.62%. So it was our best performer out of those 7 companies here today. Without a doubt, Amazon was the worst of the bunch, and right there in the middle of our screen, look at how bright red that is. One of the worst performers in the S&P 500 today. So remember, we've had a few of those days over time, especially this year, where we had a reasonably good-sized sell-off on Wall Street. But what we found out when we dug underneath the hood is that a lot of the Magnificent Seven companies were actually holding up a little bit better. Today didn't seem to really be one of those days. They were coming after all of them today. It didn't matter. There was sell-off across the board. You can see that from some of the others that kind of showed up on our radar. Estee Lauder had a tough day, down over 4%. That makeup company has been really struggling this year. A lot of consumer staples have, but that one in particular has taken it across the chin. Was widely regarded as a pretty strong company, for quite some time. But boy, the wheels have come off of that one here this year. Another stock within the consumer staples that did terribly today was Philip Morris International, boring old tobacco company. This is the company that sells Marlboro cigarettes outside of the United States. Remember, MO sells it inside the U.S., but this would be more of your international markets. They had a tough day. That's not a normal day for them to be down about 3%. Target also struggled today, down about 2.5%. We'll actually be talking about that company a bit later. Cisco Foods was down about 3 to 4% today. That's a dividend aristocrat company there. That company had really struggled during COVID, and the share price I think fell something to like $27 a share or something crazy back then, as our economy was seizing up. But then it had a remarkable recovery, and I think it went back to all-time high as well. All of a sudden, it's kind of starting to fade here a bit more recently. Again, let's ticker symbol SYY. So those are those are some ideas that come from the generally quiet consumer staples area. Kind of sticking with that theme, if you thought today was a day that maybe the boring old utilities would help bail you out, you probably didn't like what you had to see when it was all said and done, because down below you can see the utilities got absolutely smacked today. Many of them down 3% or thereabouts, and so not a single up mover here within the electric utilities industry group. Not a single up mover within the utilities from a diversified perspective. Not a single up mover out of the renewables. Not a single up mover within the regulated gas utilities, and not even a single up mover within the regulated water or the independent power producers. Now remember, these are only the utility stocks in the S&P 500, so without a doubt, if we searched a little bit harder with some of the mid-cap stocks, we'd probably find an example or two where we do have some green there. But in the S&P 500, from what I can tell here, every single utility stock was down today. That is not normal at all. We also saw that a lot of the materials companies were down. It looks like the vast majority of them, in fact, it might be all the materials companies appear to be down to my eye here as well. So that's two entire sectors without a single up mover within them. If we look at some of the other areas, it's a little bit more hit and miss. You had a lot of selling, of course, in the financials today as well. But there, at least, you did have a few that managed to close in the green. For instance, PayPal managed to close up just barely. Arch Capital was up. Chubb, Travelers, a couple boring insurance companies that managed to barely squeak out some gains. CBOE, Global Markets, managed a small gain there as well. So you had a couple up movers there, but it was pretty bleak there within the financials as well. Healthcare, Amgen and Gilead, a couple of well-known dividend growth investing companies, managed to close in the green there, as did Biogen. That one doesn't pay a dividend, but the other two do. But they were somewhat rare. Most of the healthcare companies were down today as well. In fact, I think I heard them say on CNBC earlier this morning that healthcare stocks are underperforming the S&P 500 to its greatest degree in, I don't know, something like over 15 years or something like that this year. That's how strange of a year it is, where healthcare, which generally holds up a bit better when we have selling in the market, it's just not holding up its end of the bargain this year. A lot of that could very well be because of those weight loss drugs. That's kind of scaring everybody. It sounds like a good thing on the surface, and it is for perhaps Eli Lilly and Novo Nordisk, but it basically means that there's a lot of investors out there that feel like if those weight loss drugs are successful, then a lot of the companies that deal with medical devices and hip replacements and knees and joints and all that kind of stuff, there could be an impact on that down the line. It's a good thing for society, but maybe a bad thing for those companies directly involved in selling those particular products or procedures. So it's been interesting to see that story play out this year as well. The energy area, of course, has held up a bit better than a lot of the other sectors here in recent memory. Today it was a bit hit and miss there. You did have Exxon that managed to close in the green. You had EOG and Pioneer that also were in the green today, a couple of the others out there. So that was probably an area where, depending upon where you were positioned, you might have been able to sneak out a bit of green in there. Some of the consumer staples, we talked about the ones that were down a lot, but there were also some that actually held up reasonably well. Mondelez had a good day, up 1.2%, so apparently people still plan on buying a lot of Oreos even if the economy's in the toilet. We also had General Mills finish a bit higher, along with Kraft Heinz, and Smucker's was up a bit. So, a little bit of green there, but not enough to outweigh the overwhelming selling that took place out there. A lot of consumer discretionary stocks were down today as well. Very hard to find anything green there. Looks like Norwegian Cruises was up just barely. CarMax was up just barely. Ralph Lauren up just barely. Wynn Resorts was up just a touch. And then maybe this one right here, Darden, was up just a touch, but otherwise that's a pretty important sector there of consumer discretionary, and it was bleak. I mean, we hear all these talks about the unions. I believe President Biden was speaking on that topic here today. General Motors was down 2.42%. Ford was down over 1%. Tesla was down over 1%. So not a great day for the car manufacturers. Even some of the car parts companies like Genuine Auto Parts down 2.7%. AutoZone, the company that sells those auto parts to other consumers and other mechanics and things like that, was down over 1% as well. So the auto did not seem to be a place to hide out for investors here today either. So, it was a brutal day. There's no denying it. Obviously, we've seen worse days before, so I don't want to make it seem like it's cataclysmic event or anything like that. Things can always be worse, but if this felt a little uncomfortable to you today, it's because it was. We haven't seen a lot of these types of days this year. To put some perspective behind that, I'll show you over here on the platform now that only 47 companies in the S&P 500 managed to close in the green today. That is not a very good outcome, at least if you want to be bullish. Remember, it's not that we can't take advantage of market's bearishness here or there. Many of us do in the short term. That's in a lot of ways, why we do these types of videos. But I think the vast majority of us have more money on the long side of the market when we start incorporating things like 401k plans and IRAs and all that kind of stuff. In general, society would prefer to see the market go higher. And so today was a little bit of a crushing blow to the vast majority of savers and investors out there when you got literally just 9% of companies that managed to close higher, 91% of companies closing lower here today. That is an overwhelming wipeout, and clearly the bears ruled the roost. All right, let's go ahead and pop on over here to our charts now. Remember, whenever we have a day of down over 1%, I like to start off with this particular chart just to kind of give you a slightly different visual as to how volatile or perhaps how lack of volatility there has been in the market here more recently. And it's been a little bit more volatile. It's still nowhere near the extremes that we went through last fall. I think it's, us humans are short-term oriented with our memory, it feels like sometimes. But it really was just a year ago, we were going through very dramatic movements within the market. I mean, a day like this over here on October 7th, just as one random example, we were down 2.8%, which is nearly double the losses that we experienced here today. So it could always get worse. And back here, we had tremendous volatility, both swinging to the upside and swinging back to the downside. And then we kind of went into 2023, especially the summer, really cooling off when it comes to volatility. Look at how short those candles are, the green and the red ones, in comparison to the very tall candles that we saw back here, or bars, however you want to describe that. And then as we've gotten through the summer and headed now towards the fall once again, notice that these bars are starting to stretch a bit more once again. So I hope we don't have a repeat performance of what we experienced last fall, but at this point, all bets are off in that regard. It's entirely possible. It kind of feels a little bit uncomfortable, feels like walking on eggshells. We know this is a a bad time of year traditionally from a seasonality perspective. But we also know that October oftentimes sets the low for many of the previous pullbacks in the market that we've experienced as well. Whether it happens this time, anybody's guess, but at least that thought will kind of enter into the ether of all of the various traders and investors out there. And sometimes seeing is believing, and then one person starts seeing a little bit of a rally, and those that are short start jumping on to cover their shorts, and so on and so forth, and things can move pretty quickly the opposite direction as well, right? Even back here on this candle in November of last year, the market was up 5.5% in a single day. Isn't that crazy to think about? And so, that's when we really started gearing up for a pretty big move for, the next 10 months or so. So that's a possibility. It's something to keep in the back of our mind. You'll notice here that we were down about 1.47% today. That was actually less than we were down on Thursday. Now, for those of you that follow me on Twitter, you probably saw that I was in my old stomping grounds of San Diego. Some of you know I used to live there for a few years after college. Really enjoyed that, so went back and relived some good memories there. But point being, I was away from the market on Thursday and Friday last week. Trying to enjoy a little bit of time at the beach and things like that, Padres games, all that kind of fun stuff. Little did I know when I got back and started kind of, plugging away at my phone and seeing what's been going on in the world while I've been out enjoying the sunshine, realized the market had a pretty big sell-off day. I noticed this morning that we were actually down almost identically to the lows of Thursday. On Thursday, we were down 1.64%, and at our lows here today, we were down that much as well. It's just that we had a little bit of a rally in the final half an hour or hour or so of the day. So it didn't end up closing directly on the lows, but basically, for all intents and purposes, matched the aggressive selling that we experienced just on Thursday. So that's a pretty quick little turnaround, right? It's kind of one of those things where when it rains, it pours. And as you can see, here in just the last couple of weeks, we've had that candle right there on September 15th. That we were down more than 1%. Remember, when it stretches below that blue line, that means that was a 1% drop in the S&P 500. So that was September 15th. Then we had this candle right here on September 20th where we almost got there. Well, not quite. We stopped just short where we were down 0.94%. So you could pretty much chalk it up as a 1% loss that day, even though officially it didn't close there. But it was kind of the same type of psychology. And that was last Wednesday. And then last Thursday is the one that I had mentioned before, down 1.64%, and now, of course, today, down 1.47%. So, out of the last, 7-8 trading days, we've had basically 4 of those that were down 1% or more. And it has made this market feel really uncomfortable to a lot of folks. Now, despite those feelings, one of the kind of strange things that you will notice here is that the VIX, which is this purple line down below, is only at 19 right now. Isn't that crazy to think about? You can read that in this label down here, by the way, as well. But, that is a far cry from the volatility that we were experiencing last year. Back in this area, our VIX was up here above 30 just 1 year ago. And now our VIX has rallied all the way to 19. I'm being facetious there because, of course, 19 on a historical basis is not viewed as all that volatile. Yet it kind of feels like that's how most of the market participants are feeling. I think part of the story there is, in this case, market participants are a bit more justified in their feelings of this being a very volatile, uncomfortable market, because this has been a strange market where up until recently, it had been the Magnificent Seven really carrying the load for the whole market. We've seen many sectors, especially those interest rate sensitive ones, utilities and consumer staples and REITs and healthcare companies, that have woefully underperformed this whole year. So, if you're in the wrong sectors, which, I've got my hand raised right now as a dividend growth investor, because a lot of those kind of mundane, boring, defensive areas is where a lot of my long-term investments are personally. And even for me, it's felt maybe a little bit more uncomfortable than what appears through the eyes of the VIX itself. Remember, the VIX is tracking volatility directly through the S&P 500. And since the S&P 500 is a market cap weighted index, then it's really your Magnificent Seven that are of the utmost importance to that. And so, yeah, we had a day from Amazon today where we're down 4%, but for the most part, that Magnificent Seven cohort has been up nicely here in 2023. So you might have some healthcare stocks and some REITs and some, staples and things like that that are down like 40%, but you're not really picking that up through what's going on with the VIX, because in the VIX's eyes, those companies are basically meaningless. What really matters to the VIX's eyes is what's the volatility with the mega cap tech-oriented companies that are out there. But I found that to be fascinating as well, because I actually hadn't looked at the VIX since I had left last week. And when I pulled it up here, I was expecting to see it easily into the 20s. And I'm like, wow. So after, these 1% effectively or plus bigger sell-off days in the last couple of weeks, we can only get the VIX to 19. It's kind of a joke. So we'll see where that takes us. I don't know if that's good or bad, because maybe the worst is yet to come, right, from that perspective. A lot of times you don't have the makings of a market that can basically heal itself until there's a massive washout. And if your VIX is only at 19, you're not going to really get the sense that you've had that washout yet. And so if you haven't had it yet, then there's always that lingering thought in the back of your mind that it's yet to come, and there's always going to be another shoe to drop, right? And that tends to concern the market a bit more. So anyway, another thing that you'll notice here is that the S&P 500, with this swoon that we've had in the last couple of weeks, has now easily gotten below where it was trading here on the 18th of August. And so that was about a month ago, but that was kind of, let me stretch this out here so you guys can see this a bit better. But back here, when you had this big pullback after the late July kind of top right there, and you had this big pullback to this level in August, I think there was still some hope and some enthusiasm as we got up and off the mat there that was just going to be par for the course, and we could still stretch out these higher highs and higher lows. Well, when that rolled over here on September 1st, so it's been an ugly month, right? Because that was effectively, from an intermediate perspective, one of the tops or the highs in the market, September 1st. It's only September 26th right now. But in 26 trading days, or whatever it's been, less trading days, I suppose, 26 calendar days, this is the damage that has been done. And with so many of these candles looking as ugly as they have, we have now gotten down below this low right here, which matched up pretty nicely with this low back on June 26th as well. So some folks might have been looking at that as kind of like a double bottom opportunity to kind of build upon and get some constructive bullish activity off of. Well, with the last 3 out of the 4 days, we've washed those hopes away, and now, who knows where the next level of support is. You've probably got some areas of support here around 41.75. You have a lot of these old resistance areas as touch points that could very well become new support, but that's another 100 points away from where we're at right now. Today we lost 63 points, so it would be like 2 more days like today, we could be down in that area, right? So we'll keep our eye on that situation, but it is true that they always say that when stocks go up, it's like they're taking the stairs, but when they go down, it's like taking the elevator. And it kind of feels like we're in one of those elevator kind of moves right now, and we're just looking for some stability. Maybe that can be provided around that area right there. But this was definitely not a good look for the market to be breaking through that important support area there around 43.30. All right, let's go ahead now and get back on track with kind of our normal 4-grid routine. And that way we can compare what happened with the S&P 500 to the other 3 major equity indices. And as I mentioned before, S&P 500 down 1.47%. We closed a little bit off the lows, but not much. And you can see that this, now that you can see these candles a little bit better, notice those red filled in candles are coming back to haunt us once again, basically meaning that we're closing near the lows of the session. Not a good look if you want to be bullish, because it's basically saying people are willing to continually sell their stocks at lower and lower prices when they're getting less and less money to be incentivized to sell them, but they don't care. They're just trying to get the heck out of the way and let other people play that game. So we're getting a little bit more of that emotional type of behavior here in the last week, and this has happened as we rolled over right at that falling 30-day moving average there as well. Notice that in this move, ever since topping out back here on July 27th, we haven't really had all that much in the way of yellow or green colors on the moving average. The dominant color has been red, basically meaning that that falling 30-day moving average is more likely than not to be acting as resistance right now. And every time we kind of get a reflex move up to that level, the sellers are willing to step in and let go of their merchandise if the price is right. So not a great point to be in. Here you can also see now that we're looking at a 3-month chart that the S&P 500 is at 3-month lows, right? You would have to go back, let's see, on a 6-month, you would have to go back to basically the first week of June since we were at these prices. So just like that, we wiped out all of the good graces of the summer and we're right back to where we were, as we kicked the summer off. So not a great look there at all, as we are basically at 3-month lows or 4-month lows. Let me go back to the 3-month chart here. So you can also see on this chart that the background color is dark pink, and that is the case for all 4 of our charts. What that identifies is that according to the market forecast technical indicator, which is this little indicator that's below all four of our charts, that the posture is bearish, not only bearish, but strongly bearish, right? There's kind of a differentiated shading of that pink. When it's light pink, then it's kind of what we would refer to as weakly bearish. If it's dark pink, it's strongly bearish. And for the S&P 500 and the NASDAQ, those had held up a little bit better. Again, that's where you're going to find your highest concentration and biggest impact from your Magnificent Seven. So they had been holding up a bit better, but even that, we've been bearish for the last week on both of those. The Dow was a little bit worse than those two, where we've been bullish for really the last couple of weeks. But look at the Russell 2000. It just cannot get out of its own way. We've been in this strongly bearish posture for, basically 3-4 weeks at this point. So anyway, and many of them, you can see, came with these oversold cluster signals that are stacking up day after day after day after day. And a reminder that those things do not have to work after just one of them. I wish it was that easy. It's not. Sometimes you get lucky with them, like over here. NASDAQ Composite had a couple of oversold clusters. You only had to endure two in a row, and then we had a nice little reflex rally. So far, we haven't really seen that type of a rally off of these oversold conditions from the Russell 2000. So could that be in the cards? Potentially, but we also have to acknowledge that nothing is guaranteed in this life. So we don't want to go too hog wild with any one indicator. You want to use indicators in conjunction with one another to try to establish your best next idea from a trading perspective. But it is true that all 4 of these charts do remain in that strongly bearish posture as they were last week as well. You'll notice that all 4 of them also have red 30-day moving averages, meaning that all 4 of them are trading below their falling moving averages. You'll also notice that the low label is below today's candle on all 4 of those charts. That's not a good look either, because basically what it's saying is that all 4 of these charts are at 3-month lows as of today. Had you been buying stocks at any point since basically the end of June, so think of basically the whole summer, if you were buying stocks out there, chances are strong that you're losing money on those stocks at this exact moment in time. Obviously, there's exceptions to that. Some of the energy companies and things like that have held up a little bit better, but the chances are extremely high that a portfolio of stocks that you would have bought at any point since June, you're now losing money on. And if that's the case, don't feel bad about that. It's kind of my point of mentioning that. Sometimes people beat themselves up quite a bit and wonder what they're doing wrong and that sort of thing, and if they're just picking all the wrong stocks or what have you. Well, the truth is, most people, no matter how great a stock pickers they are, their baskets of portfolios are down had they established those baskets of portfolios at any time in the last 3 months. So don't beat yourself up too much. I always like to remind folks when we get into more difficult conditions like we find ourselves in right now, that when I got started, it's been a long time. I might not look that old, but if you look close enough, I've got plenty of gray hair. But I was ready to invest in late 1999. This is back when I was in college. So got all encouraged by the NASDAQ trading and all this kind of fun stuff I would see back then. Of course, the internet was just coming to life at that point for the most part, and online brokerages became a thing. So I figured I want to try that out. I was ready to invest in 1999, but I heard of this thing called the Y2K bug, and I know it sounds silly today to those of you who are younger, but the world was truly concerned that the computers across the globe would somehow freeze up or seize up or shut down because of us having to turn the clock to the year 2000 when there were 4 digits, because prior to that they would just say 99 or 98 or 97 or what have you. So anyway, it was kind of a silly thing to think about now, but at that time I decided not to invest until January 10th of the year 2000. And one of the stocks I bought that day was JDS Uniphase. And for those of you that have been around long enough, you'll recognize that name. For those of you that are newer, you probably won't. But let me tell you that it was one of the poster children of the dot-com implosion. And so I've been there. I've been through the pain. I've been through the ugliness, and I'm still here, right? That's the main thing. Do not blow up your portfolios, right? Do whatever it takes to stay in this game, because this game will produce success for you if you endure it long enough, right? Stocks do go up over the long haul. All you have to do is look at the S&P 500, and we can hyper-focus on all the terrible activity in the last week here, but then we can also remind ourselves that when we go to a maximum chart and it looks like this, that people who got bucked off along the way on this ride probably today, where you have to squint to see that we're down at all, probably are regretting that. So, I always like to give that little pep talk, especially for those of you that are newer, where you might not have experienced a lot of market downturns in the past. But in my case, basically as soon as I got started investing in the market in the year 2000 was pretty much right when the dot-com bubble was imploding. And by the end of that year, we pretty much knew things were not going to be the same for quite a long time. So, as long as you can survive and not blow yourself up, there will be better times in front of us. I feel confident in saying that. There will be sunshine after the storm, so to speak. So keep your head up. I know these are tough days, but we'll all get through them, and we'll find opportunities for the future there as well. So that's your 4 grid here for the day. One thing that's a little bit surprising is we didn't actually have any oversold cluster signals on these 4 charts today. We got really, really close on the Dow. You can see that the blue line was at 23. Remember, all 3 of those lines, the red, the blue, and the green, have to be below 20 on the same day. So we were really, really close on the Dow, but not quite in there. Maybe tomorrow that will happen. So we'll keep our eye on that, and I'm sure if it does, David will let you know in his presentation. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. Also, as I look over here at what's happening and I see the Rams at the Bengals, congratulations to all of you who live in Cincinnati. It's kind of funny because we actually have a lot of market scholars at our premium education business that for whatever strange reason, they reside in Cincinnati. And I think part of it, at least in my case, as a guy that's been teaching dividend growth investing all these years, Cincinnati is a great town for dividend stocks, whether you're looking at Procter & Gamble or Kroger or what have you. So maybe there's a connection there. But we like to have a little bit of fun with each other with our NFL teams. And I had to razz the Cincinnati fans a little bit a couple of years ago when my Rams took them down in the Super Bowl. So they deserve to get a victory back against us last night on Monday Night Football. I didn't think either team played particularly well. I think both of them have the talent to look a lot better than they did. But it is true. The Rams didn't deserve to win that game last night. So an official congratulations to all of you Bengals fans out there. All right, let's do some shout outs. Thank you to the 104 of you that clicked like for me the last time I did the video. Remember, anytime we're up and over 100 likes, I plan on doing a full-length video the next time I'm scheduled to do that. Same thing goes for this Thursday. So if you want me to do an hour-long video, click that like button. If you prefer the shorter videos, then don't click the like button, and we'll be just keeping it to 15 minutes if that is the case. So we'll let you guys decide. But for those of you that helped me out last time around and helped support us, let's do some shout outs. Thank you to Neil. Thank you to Jim. Thank you to John and Fred and Vernon and Fun Jonesy and Steve and Evan and Kenneth and Roger and Paul and Nietzsche and Sandeep and Jayesh and LL Zhao and Rich and Jim and Tom and HR and Eugene and Gazward Boers and Rams. How about that? We got a Texas Rams fan there. All right, I like what I see. How about Keith and Trunk and Dom and Brad and Paul, Dave, David, Ryan, Surendhar, Phil. I can't get to all of you, but I'd like to think that as time goes along, you guys see your name get rattled off every so often. We do really appreciate you guys supporting us. It means a lot to both David and I, so please continue that. All right, let's now have a little chat here about our sector selector tool. And as you can see, this was updated over the weekend, so even though I was on the road, I had a few minutes to spare to update our tools after the markets closed on Friday night of last week. And you can see that both our sector selector and our stock selector tools you can find under our premium tools tab here if you are a premium member of Market Scholars. Remember, we use this tool here, both of those actually, both the stock selector and the sector selector, in our top-down trend trading class here at Market Scholars. But you're welcome to use it for whatever purposes you like as well. Note that energy stayed up at the top. Once again, it was 1, 2, 3, 4, 5, 6, 7, 8 weeks in a row for energy up in the top slot. They have been one of the only areas to retain some sort of semblance of bullishness. And even there, we've seen a bit of wear and tear here recently as the markets have struggled in the last week or so. But even like today, as I mentioned before, ExxonMobil was up as just one example. So there is still interest from buyers out there at the right price within energy, whereas you don't really get the feeling of that in some of these other sectors that are out there. Financials stayed at number 2, so that probably bodes well for the value factor. We'll talk about that tomorrow morning in my factor-based swing trading class with our premium members. But value as a factor generally has a pretty big allocation to the energy and financials sectors. Information technology actually had a little bit of a boost there last week. That's a little bit surprising. So it basically means that although technology struggled, others struggled even worse. And I think that probably could be said for the utilities as well. Remember, the utilities were dead last for the longest time, and now they've worked their way all the way up into the top 4, which is rather impressive. But I always like to remind folks, remember, first of all, this is a graphic that is built upon statistics using an equal weighted basis, not a market cap weighted basis. And then the other thing is, this is looking at things through a relative lens, right? You don't see like percentage numbers of how much these are up or down or what have you. That'd be a little difficult because my scoring method actually uses 3 different time periods to spit out the rankings. But regardless, point being, you will want to make sure that you understand that these are just being compared to one another and then ranked according to however they come out that particular week when I'm doing the rankings. And so you could have moments in time where you have a major sell-off in the stock market, but you're always going to have stocks or sectors in this case that are ranked, number 1 and number 2 and number 3. It doesn't mean they have to be up. They could all be down. It just means that they're down less than the ones at the bottom, right? So, and remember, the flip side of that is also true. We've been in other types of market environments where we've been in a robust bullish market environment and all sectors are up, but there's always still going to be one that's listed at number 11 or dead last. They might only be up a little bit when the rest of them are up a ton. So it does work both ways, but obviously right now, with as difficult of a market it's been in September, the expectation would be that most of these sectors are down in negative territory. It's just that some of them are outperforming slightly compared to others that are down much worse. So utilities, from kind of a more defensive posturing perspective, had a pretty good response last week. I'm a little bit nervous about where they might end up this week because, again, as I mentioned here earlier, all the utility stocks in the S&P 500 were down today, and many of them were down like 3%. So it was not a good day for the utilities. So just when it looked like they were starting to have a little bit of relative outperformance, today kind of throws a wet blanket on that. And so it's going to be curious when I redo these rankings again on Friday whether utilities will stay in the top 4 based on what I saw today and not knowing what's going to happen on Wednesday, Thursday, and Friday. I would say that there's a pretty decent chance that the utilities stay in the top 4 will be quite short and it will be replaced by something else. But we got plenty of time before now and then, so we'll find out. But just kind of trying to share my thoughts along the way as I'm seeing this play out as well. You saw big drops in materials. You saw a big drop in real estate. And then you had the 3 bottom ones stay exactly the same. Consumers are out of favor right now. Consumer discretionary, consumer staples are 2 out of the bottom 3 for the second straight week. And remember, normally those 2 aren't usually positioned next to one another. Usually, consumer discretionary is doing well when markets are bullish. Consumer staples are doing well on a relative basis when markets are bearish. Those 2 have different products that get sold. Obviously, the discretionary would be more of the wants, and the staples would be more of the needs. And when the economy is really, really humming along and very strong, then you have more of the wants that get the money spent on them. And so discretionary tends to do quite well. Whereas when you have a market pullback and people can't afford to be, taking their trips around the world and buying their brand new electric vehicles and all this kind of stuff because they're worried about keeping their job, that's a time when the peanut butter and jelly companies and the bread companies and that sort of beverage companies start outperforming. But we haven't seen either of those working here recently. And part of the story there might be one of the things I had mentioned on Twitter earlier today, talking about some of the student loan repayments that are anticipated, and fewer dollars in the pockets of consumers out there could very well lead to fewer profits as well from the companies that you would be able to invest in the stock market. So both consumer areas out of favor here at the moment on a relative basis, and healthcare is as well, as I kind of mentioned here earlier. All right, let's go ahead and get back on over to our chart analysis, and let's do some 12 grid analysis. Starting with chart 5A, this is our asset class 12 grid. As we look at this, we can see it's mostly pink charts, with a few exceptions down on the bottom rung, and just like was the case so often in 2022. So many of you, of course, have been with David and I can't remember when we first started this video, but I want to say it's been like a decade at this point that we've been doing the video. For the longest time, David used to write the little paragraph on the Invest Tools website, but he didn't start the video until several years after that. But I think even by now, we've been doing this video for like 10 years. And so for many of you, you know the drill, but we also have brand new people that check us out on YouTube every single video, so we have to kind of speak to a broader audience as a result. But for those of you that were not watching these videos last year, you might not be aware of this, but in the 2 bottom corners where you've got the US dollar on the bottom left and you've got the 10-year US Treasury yield in the lower right, those 2 were green many, many times last year when pretty much everything else was in the red. And just so you know what you're looking at here, when you have a red or a pink background color, what that means is that you have a bearish market forecast posture. If the background colors of these miniature 12 grid charts are green, it means you have a bullish market forecast intermediate posture. So what we found so many times last year, to the point where I was getting sick of saying it, and you were probably getting sick of hearing it because it usually meant bad things for your stock portfolios, is that when the US dollar is strong and the 10-year Treasury yield is strong, or in other words, the interest rates are high, that is not a good combination for the stock market. In fact, I remember saying this about a month or so ago as well, when both of those were in a pretty significant upswing, and I was like, this is kind of weird, because last year when this was playing out like this, the stock market was doing terribly. Well, maybe there was just a little bit of a delayed function from that perspective, because now we can see that the stock market is doing terribly. Be careful with what you wish for, I suppose, in that regard. But it is true that there are legitimate reasons why when the US dollar is strong, the stock market will struggle, and why when interest rates are high, the stock market struggles. Right? They should be pretty obvious, but there's a little bit of nuance to it as well. There's There's many, many things that can make stocks either go up or down. These are just part of the stories that are out there. But naturally, high level speaking, when interest rates keep rising, and notice that we are at multi-month highs on the 10-year Treasury yield right now, we're at 4.55%, that is difficult for corporate America, right? When more and more of your, profits and cash flows and revenues and all that kind of good stuff that normally would be kind of deferred towards the shareholder in the form of dividend payments or stock buybacks or all that kind of good stuff from a capital allocation perspective, when that starts getting chewed up by interest charges, that's not a good thing for the stock shareholder, right? It's an okay thing for the bondholder because they're getting paid. But that takes money away from what would otherwise be helping support the stock's price. So in general, when you have very leveraged companies, which we have a ton of in the United States, it's one of the things that has been kind of a perennial worry for the markets for years at this point. Obviously, it's coming a little bit more to fruition now that we have rising rates. But I mean, there's a lot of zombie companies out there that have been basically just kept afloat because of their ability to borrow money at very cheap interest rates. Well, it kind of feels like that era is the door's already shut, right? And we're probably not going to be getting back there anytime soon. And if we do, it's probably going to be because the whole economy and stock market just torpedoes lower, where the Fed has no other choice than to push interest rates lower. But right now, the natural order of things appears to be higher for longer in terms of interest rates. And that is a direct negative to corporate America that would much rather have much lower interest rates to refinance to and then redeploy the excess capital to shareholders. Right now, they can't really redeploy as much excess capital to shareholders because it's going to the bondholders to make sure that they're taking care of their contractual obligations on the bond side of the structure of their organization, right? And paying for those bond interest payments along the way. So anyway, there's a legitimate business reason. It's not just, hey, we look at this chart and whenever the yields are up, we just dislike stocks. No, there's actual fundamental reasons underneath the surface of why this is bad for corporate America. And then on the US dollar side of the equation, remember, we are very fortunate in the United States to have some of the world's most dominant companies, right? You always see those lists of like the biggest companies on the planet. And if you have a list of like 20 of them, about half of them reside in one single country, and that is the United States of America, which of course makes me happy and proud and all that kind of good stuff. Of course, we have a worldwide audience here, so we don't want to be too insular from a U.S. perspective. It's a big, beautiful world out there, and we welcome all. But it is true that we are very fortunate in the United States in terms of how deep and wide our pool of potential investments are. And we have some truly world-beating and world-dominating brand name companies that reside here in the United States. Think about companies like McDonald's and Coca-Cola and Pepsi and Procter & Gamble, even Apple and Microsoft and the big tech companies, right? They're headquartered in the United States, but many of them get just as many sales, if not more, from outside of the United States that they need to then bring back to the United States to tally up when it comes to earnings season. And if the dollar is too strong and they're selling all their iPhones and cases of Coca-Cola and all that kind of stuff globally, they're going to have to convert those weaker currencies like the euros and the yens and the yuan and the rubles and all that good stuff into a stronger dollar. It's going to make it look as though they actually made less money after those conversions have been made. And that, again, is meaning less money that can be doled out in the form of dividends and less money that can be used for stock buyback programs. So generally speaking, you don't want to see the US dollar too strong. I think more times than not, we hear that as Americans. We say, oh, well, how great is that? King dollar, right? Our dollar is so strong, and we kind of puff our chest out and say, how great is it that we can go on this international vacation and spend less money than we would have otherwise because our dollar is so strong. And then people look at their stock portfolios and are like, whoops, our portfolio is down like 20%, and that's a lot worse than saving a little bit of money on buying some trinkets when you're over in China or something like that, or Berlin or Paris or wherever you want to go. So in the end, careful with what you wish for there as well. Generally speaking, I've found it in my years of investing and trading, that it is a much easier investing environment when the dollar is weaker, not stronger, despite the patriotism that oftentimes comes with that phenomenon. So as you can see, it wasn't just the 10-year U.S. Treasury yield that hit multi-month highs. Same thing goes for the U.S. dollar. Now remember, here we're using this versus a basket of other currencies through the form of UUP, but there could be some one-off currencies that if you compare them to the dollar out there, they're doing a bit better. But across the board from a diversified basket perspective, the dollar is very strong right now, and that is yet another headwind to not just U.S. multinational companies, but also a headwind to companies that reside directly in foreign lands. And so if you look up at the top here, notice that EFA was down 1.3% today, and EEM was down 1.4%. Both of them held up actually a little bit better than the U.S. today, which is maybe a little bit surprising, but not by much. It's not like we're saying, it was a huge amount of outperformance. We're kind of splitting hairs. They were all down approximately the same today on a day when the U.S. dollar was roaring higher once again. Now, in terms of the developed foreign stocks, now that's going to be Japan, Australia, a lot of Europe. We actually do have an oversold cluster signal on EFA here today. So maybe we will have an opportunity to see a bit of a reversion to the mean type of a move. This is actually the first oversold cluster signal on EFA in the last 3 months. EEM actually had back-to-back oversold cluster signals here in the middle of August, and that actually led to a very promising rally. We know now that it failed, and remember, most of them will, but what you're hoping for is that at this exact moment in time, it's so bad that it could be good in the short term, and that is what you got out of this. I would say that worked pretty much the way that my expectations would have been. We got a reversion to the mean move, and we failed at that moving average, and now we're cutting back through those lows once again on EEM. You can see that kind of happened here with preferred stocks as well. You had those two little green dots showing up. We had this reversion to the mean type of a move. And so who knows, maybe this is EFA's moment to go through that exact same process. Maybe you get another day or two of selling here, and then you get some sort of a reflex rally, maybe starting next week or something like that, right? So keep your eye on that possibility. Keep in mind that when the dollar is strong, you oftentimes see some disruption in the commodities markets as well, because most international commodities are priced in US dollars. So gold had a really tough day once again. It was down 0.8%, and as you can see, that was a gap down. We're now below the falling 30-day moving average on gold, just like we are with foreign developed and emerging stocks, and we still have that strongly bearish posture on gold as well. Oil has been a little bit different this year. Oil has not acted like the traditional commodity that kind of gets pushed around by whatever's happening with the US dollar. There's their own internal dynamics that are taking place with oil. And of course, we all know that we're kind of struggling with the whole Russia-Ukraine situation still. A lot of those geopolitical events that can impact the price. And of course, you also still have to deal with supply and demand. It was kind of interesting this weekend when I was down in San Diego. I was shocked by the gas prices. I live in Utah, and even here it's high because this summer I was visiting some relatives out in South Carolina, and I was shocked at how cheap gas was out there. I mean, anything under $3 is considered cheap to those of us that live out west. But even our $4.50 gas that we are paying on average here in Utah looks like a bargain compared to what you folks are having to put up with in California. I mean, that is jaw-dropping stuff out there. I saw a lot of gas stations where a gallon of gas was $6.70. And of course, those of you that are joining us from outside of the United States, you'll tell me your war stories as well, where, if you go over to Europe and you kind of converted it to the same type of system from a volume perspective, that the prices over there are even worse than in California. So I guess it's all relative, but it's shockingly bad in California. When I used to live in California, I remember it would feel really uncomfortable when prices got to $5. Like, that was almost unheard of back then. Today, you're breaching like $7 in some unique situations there, and I suppose that the consumers really aren't flinching all that much. One of our Ubers this weekend was in a Tesla, and it reminded me of why there's probably a lot of interest in electric vehicles in California if they have to put up with those types of prices. So, oil is still getting used to keep the economy humming along, whether it's for chemicals or plastics or shampoo or the traditional use of pumping it into your vehicles. There's still plenty of demand globally where that dynamic has allowed oil prices to stay elevated. My understanding is that there has been very little in the way of reinvestment into that industry because a lot of those oil companies are not incentivized to do so. Many of them are kind of vilified by politicians and others, and they're basically turning their businesses into an extraction machine that basically just converts oil and gas into dividends for shareholders, but not really building out more exploration and production facilities for the future. So I think that's playing a bit of a role here as well. Throughout the generations in the last several decades, you've had these oil companies that have constantly reinvested in themselves and trying to replace whatever it was that they lost by finding new oil fields or developing new technology for horizontal drilling or going offshore. And now, because of the way that they're being treated by politicians, there's less incentive for them to actually do that. And therefore, we probably have a bit less supply than we would otherwise. And that's affecting the pricing of this as well, right? It's economics 101 when it comes to supply versus demand. And if there's not enough supply to meet the demand, price has to go up. And that's kind of where we're at with oil right now, despite the rising dollar. Let's now take a look here at what's been going on from a sector perspective. Remember, this is now looking at it from a market cap weighted perspective. And as you can see, every single sector is down. Yikes, not good, right? Or I shouldn't say everyone is down. Technically, I guess that's true for today as well. But what I meant to say is that every one of these is a pink background color, meaning that the posture is bearish. And, when I posted the sector selector online over the weekend on Twitter/X, one of the comments I got from somebody said, I'm surprised that energy is still number one. They've been getting hammered lately. And I'm like, really? I haven't really noticed that. I mean, I was, like I said, I was kind of unplugged from the market, so I didn't necessarily think that it was wrong. I just hadn't checked, so I wasn't sure. So when I got back to my charts, I wanted to look at what was going on with energy because I thought, well, maybe they've just been collapsing or something like that. Well, you look at the chart of energy compared to all the rest of these, and you can see why it's still number one on the sector selector. I mean, it's the only one that has a green moving average right now. Sure, we're down over the last week, but let's be honest with ourselves. This looks like a dream compared to what's going on with other sectors that are out there. I mean, utilities falling off the map, discretionary falling off the map, industrials falling off the map. A lot of these are actually hitting 3-month lows right now. I don't have my low tags on these particular charts because it would take up too much room, but I already mentioned the S&P 500 literally hitting 3-month lows today. Technology sector literally hitting 3-month lows today. Discretionary sector literally hitting 3-month lows today. Industrial sector literally hitting 3-month lows today. Materials sector literally hitting 3-month lows today. Consumer staples literally hitting 3-month lows today. Utilities literally hitting, boy, I'm getting sick of saying literally hitting 3-month lows today. And one last one for you, real estate literally hitting 3-month lows today. So when you take it in context, some of you might feel like, wow, we've really been getting hit on energy lately. Have you seen the pain in the other sectors? And that's why you will know that energy remains easily at the top of the sector selector. It's not even particularly close, right? They're by far the only one that it still has that green moving average. All the rest of them not only have red moving averages, but there's not even a single sector that's even close to their moving average right now. They've all fallen off the map from that perspective. So yes, it's true that energy has a weekly bearish posture. That's that lighter shade of pink that you see back there, whereas all the rest of them have that darker shade. So it's just one other way to identify that energy is the one that's holding up the best out of all these, despite the aggressive selling that we've seen all across the board. But it was a tough day in the market without a doubt. Looks like our worst one would have been utilities. So I'm glad that my eyes weren't deceiving me when I was looking at that heat map before. Utilities were down 3% today. That is supposed to be the boring, calm area of the market, down 3% in a single day. The worst performer out of all of these here today. The best performer out of all of these here today was the aforementioned energy. So that's another way to identify you're just not seeing nearly as aggressive of selling in energy, despite what you might personally think about your own energy stocks. The proof is in the pudding. They're actually holding up better, not just today, but over multiple months, right? They're much closer to 3-month highs than 3-month lows, whereas most of these other charts are the exact opposite. So in terms of those sectors that have oversold cluster signals today, you had financials that had an oversold cluster signal today. You had consumer staples with an oversold cluster signal today, and you had real estate with an oversold cluster signal today. So I wanted to concentrate on the consumer staples area for our trade application example. So let's start having that conversation. Those of you that have been watching this video long enough will know that typically if we have a day where the market sells off by more than 1%, and it happens to be a Tuesday or Thursday when I'm scheduled to do this video, that the trade application will likely be a sold put trade. That's an idea that requires a little bit more of a commitment level, and it's probably not right for all of you because it requires somebody to be a little bit more brave than maybe they prefer to be, because it's basically you putting yourself on the line. You're on the hook for buying 100 shares of stock for every put that you sell at whatever strike price that you select. And so it's not for the faint of heart, right? It is not what I would call a conservative strategy. It is a more risky strategy. And that's why with my students, I always remind them that they should only be selling puts on stocks that they truly want to own at the strike price for the long term. And if that does not identify you, then you should pass up on those trade ideas, right? But if it does, identify you, then there can be some perks there as well. So let's talk about that. Some of you might have seen my post on Twitter earlier today that kind of led to this conversation a little bit more. So let me kind of catch you all up to speed, because I know not all of you are on Twitter, but for those of you that are, some of you might have seen my post here about Target, which is what was kind of on my mind today. I was a little surprised when I looked at some of the damage that was taking place in the markets and just happened to notice that Target had a yield of 4%. I'm like, wow, that's pretty rare. When was the last time that happened? So as I mentioned in the tweet or X post up here, Dividend King Target, and remember, a Dividend King is a company that's raised its dividends for 50 years in a row or more. Target used to be known as Dayton Hudson, for those of you that have been in the Midwest where I grew up, more of a department store company, but then converted into a discount retailer in recent decades where they've had most of their success, but kind of a random one to be considered a Dividend King here. Nonetheless, they are, and they have continued to sell off from a price perspective. I said for the first time since late 2018, Target's dividend yield is above 4%. It's pretty rare, right? That was more than 5 years ago. Notice I did not say 2020, which is probably a lot more common for this type of a post here recently, where we say, well, we haven't seen these levels since 2020. For Target, their dividend yield right now is actually higher than where it was in the worst part of the sell-off of 2020. That's how crazy things have gotten for it. I said the highest yield it got to was around 4.73% back in 2017 when everybody thought Amazon was about to eat their lunch, right? So this is not the first time Target has been out of favor. Those of you that have been with me in my dividend classes over the years will know that. We were literally buying this company back in 2016, 2017, et cetera, back then when it had these high yields. So this is not the first time for those of you that feel like, boy, I can't believe Target's this out of favor and they have this high of a yield. It might seem extraordinary, but it's not. This literally happened within the last decade or so. As I said here, shrinkage and theft, which is a big deal, especially just coming from my trip from California over the weekend. My buddy that lives there was saying that at his Target, for those of you that live in San Diego, would be one that's close to like the sports arena and SeaWorld and Ocean Beach and all that kind of stuff anyway. He said that pretty much the entire store is under lock and key right now. And anytime you even want to buy a bottle of shampoo, even if it only costs $3, you have to get a clerk to open up the containers to get them. So it's crazy out there. And I did follow this up, by the way, with another news story that hit on Target today, which perhaps was the reason they were down so much today, that they have decided to close 9 of their stores in the cities of San Francisco, New York, Seattle, and Portland due to theft and safety concerns. We've all seen those videos. It does not look good. And, it's probably a good thing that they're getting out of those locations, because otherwise a lot of that merchandise is just going to be walking off the shelves out of the door. And I don't really think that that's the way that capitalism was built to survive and endure. So anyway, despite all of that shrinkage and theft and student loan repayments and inflation and controversy around social issues, their shares have been put on the clearance rack. So remember, when share prices go down, dividend yields goes up, and that's what you're looking at with this purple line here. It's how high the dividend yield is going up because the share price inversely is going down. But I said that its payout ratio remains fairly low. It's around like 60%. So hopefully its dividend is reasonably safe at the moment. And if you look at this chart a little bit in greater detail here, you can kind of see it, what I mean here. These 2 blue arrows will show you that Target, the last time it had a 4% yield, which you can see in this little purple bubble off to the right, was right back here in late 2018. Remember, that was the big Christmas sell-off of that year in the stock market, was the last time they were there. And then previous to that, with this red arrow over here, was basically their all-time high dividend yield of that 4.73% back in 2017. I wanted to spend a moment talking about that here in this video because it could have an impact on part of the reason that I selected the trade that I did. So now that you know that their highest yield was 4.73%, let's kind of get back on track with our normal Thinkorswim charts. And I wanted to first show you our dividend stair-step chart on Target, which is ticker symbol TGT. And you'll see that after this big sell-off we've had this year, Target has now been trading in this blue zone for really the last 3 or 4 months. Prior to that, it was not. In fact, it was so overvalued, it had kind of lived in this orange zone, right? For our purposes as long-term investors, orange is overvalued, blue is undervalued. It's basically looking at each company individually on its own dividend yield history and kind of plotting a stair step to determine where current shareholders might find value based upon what we've learned from past shareholders. And so had you been buying Target back here in 2017, when it did have that yield as high as 4.73% or whatever it was, you got a smile on your face because you're buying it under $50 per share back here. And even after the massive pullback we've had in the last couple of years, you're still more than doubling your money from some of those lower levels right there. So a lot of our early buys in my dividend growth investing class, for those of you that were with me in my final years at Invest Tools and then in my first couple of years here at Market Scholars, we're still nicely profitable on those trades, especially if you add back in all of those dividend increases that we've had along the way. And we've had some really big ones like this one right here. So anyway, people who were buying up here, they're probably in pain down here. But if you're waiting in the weeds, waiting for a pullback on high quality companies, you can basically scoop up the babies out of the bathwater when everybody else starts puking them up, right? And where we're at right now is getting a little bit closer to that. Notice that Target not only is in the blue zone, making its current dividend yield attractive on a historical basis, but notice you've got these little green dots showing up underneath the bars. Now, these are weekly clusters that you're looking at right here, which is another way to identify that the selling has gotten extreme and we might be due for some sort of a reversion to the mean type of a move there. Well, if you thought that was interesting on a weekly chart, I also wanted to show you that if you pulled up a monthly chart instead, I'm just going to look at a 20-year monthly chart here. Target currently has a monthly oversold cluster. And it's a little bit harder to identify because some of these other things tend to get in the way here. But from what I can see, just off of first blush, Target has only had one other monthly cluster in 20 years of monthly charts or monthly bars that we're looking at right here. So this is an incredibly rare signal. It doesn't guarantee success or anything like that. I'm just trying to kind of set the trade up to help you understand that this is an extremely oversold situation. This is not like a normal thing that you see happening to Target right here. This is an extremely oversold situation here that we're dealing with, and maybe rightfully so, right? Again, there's a lot of issues that they're going through right now, and many of them are legitimate business issues, right? This theft and the shrinkage is the big one in my eyes because If you're just watching merchandise walk out the door and nothing's happening to stop that, that's pure profits just going away. So they need to solve that issue for sure. So it is entirely possible the stock deserves to be down at these levels. Nonetheless, it does provide an opportunity for us to do one of these sold put trades. And remember, just because I do a sold put trade on a company with longer history of growing the dividend on a day when the market's down more than 1% doesn't necessarily mean that I expect the stock to immediately go higher. I think maybe there's some misinterpretation of that on occasion. Remember, what you're doing when you are selling a put in a lot of ways is you're playing the odds. Think of like an airplane where you've got you're 10,000 feet above land, and the market expects the stock to fall the way that you would watch a bowling ball fall out of an airplane, hopefully not hitting anybody down below in a nice barren land or something, or the ocean, and just watch that thing sink just in a straight line. Whereas when you are selling puts, you're making the bet that the stock might continue to struggle, because obviously where there's smoke, there's fire. There's real issues with the business right now. But instead of you thinking that the stock is just going to fall the way that a bowling ball would fall out of an airplane, you're thinking of it in the lines of, maybe like a feather falling out of the airplane. In other words, it'll continue to float a little bit lower, but just not at the same aggressive pace that the market is pricing in at that moment. So, it's important to recognize that as well, that you have to make sure that you are selecting the right strike prices and things like that. And what I usually do in my classes is look for the 1% return on risk. And so I went out to the November contracts in this particular case, and we sold the $90 put. And I believe we got 93 cents for that. So that's where that 1% language comes from, right? 93 cents is approximately 1% of the $90 strike price. But what that does is it now puts us on the hook for buying 100 shares of Target if it goes from 109, where it is right now, down to below 90 on expiration day. Now, if that doesn't happen and the stock stays above 90, then we get to keep our premium that we received today for our willingness to take on this risk. On the other hand, if it does continue to fall very aggressively, then you do have that obligation to buy 100 shares of stock at that price, in this case $90, and so you have to have that money kind of earmarked in a way, at least mentally, and in some cases like a Roth IRA, you physically have to have that money earmarked in order to pay for that if that happens. Now, of course, that's assuming you don't get out of the trade ahead of time, and some of you may choose to do that, but I'm really trying to emphasize the fact that I know we're selling a put on a stock that's in a terrible downslide right now. But for those of you that intentionally want to own it at a lower price, then selling a put could very well be an attractive way to take advantage of that situation. For people that don't want to own Target, then I would not say that this is a trade that you would probably get too enthusiastic about. But another thing that I had noticed about that $90 level that's kind of intriguing is you will notice that back here in 2018, so this was before that Christmas slide that I had mentioned before, you had a stock that was trading at $90. It was actually a little bit above $90.39 right here at this bar that I'm pointing at. So in other words, there is that possibility that if this stock does continue to fall, it could very well stabilize at $90 because of that technical analysis concept that old resistance could become new support. So that's another thing that is somewhat attractive about this situation. And then the other thing that I wanted to address, going back to my X post or my tweet, whatever you want to call that, is what your yield would be, right? Because we know that right now, Target's yield is 4.02%. And some of you might just decide, to heck with selling a put on it. I just want to buy it right now and hold it for the next 20 years. Obviously, you're taking risk, just like you are with every stock. But a 4% dividend yield is quite attractive for a company that is, considered a fairly good, generous dividend payer over the years. Because remember, your yield on cost will go up as long as Target's board of directors decides to continue to raise the dividend in the future, just like they have for the last 50 plus years. Anyway, if you're selling the put, remember, you're not obligated to buy it here at 109, you're obligated to buy it at 90. And so I wanted to do that calculation here with you real quick as well, where if you took, first of all, let's get our break-even price. So $90 would be the strike price that we're selling, and we subtract out the credit that we would receive up front. And I think on this trade, I got 93 cents out of it. And so our break-even would be $89.07, right? That's where you would effectively you would establish your long-term position at $89.07 if push came to shove under that scenario. So now we need to calculate, well, what do they pay in terms of a dividend? They're currently paying $1.10 on a quarterly basis. So $1.10 annualized on a quarterly basis to what that would be paid out on a full year, take that times 4, means that it would be 4.4. So $4.40 per year and per share is what they pay in dividends. So 440 divided by, what was it, 89.07? And you can see here that the yield would then be, basically, if you round up, especially with these next two being 9s and 9s, you basically would have a yield of your starting position on target of 4.94%. And again, think about that for a second, because back over here on this graph I just got done showing you that targets never had a yield that high. The highest it had was 4.73%. And what you could be setting up for yourself with this type of a trade idea is a yield of 4.94%. Now, again, that doesn't guarantee anything. I mean, you'd like to think that the dividend is secure, but you'll never know for sure. They're not guaranteed, right? So you have to be careful with that as well. But in general, if you've been waiting for your moment to take advantage of this type of a retailer and you're comfortable with their current dividend policy and you assume that they will continue to raise dividends in the future, then getting basically the best yield that has ever been presented to shareholders on record is maybe an attractive undertaking, and that's what would be required in this case. The stock would have to fall so aggressively that its dividend yield would literally be the highest of all time in this particular case. So that could be intriguing to some of you as well. I don't want to make it seem like that's the priority and the reason you take the trade, but I think for some of you that could very well be another important way to be thinking about this trade setup. Okay, so that's what I had for you. Sorry this video went a little bit longer than normal. I usually like to keep them to an hour, but I found myself kind of explaining this target situation a little bit more than I anticipated here because I think it's important for me to be as upfront with you as possible. Many of you know me as a dividend growth investor, so you know the drill by now, but I always hate to find out that some random person pushed play on a YouTube video and heard about some sort of a dividend stock that was in a downtrend and then ended up being disappointed because they didn't fully absorb and appreciate the risk and the understanding of what you were hoping to accomplish with that particular trade setup of selling a put. So hopefully that explained things a little bit more for you. I appreciate you guys all checking this out here tonight. Remember, if you want me to do another full-length hour-long video on Thursday, do me a favor and click like for me there on Twitter. It'll be pinned to the top of my timeline. If you want me to kind of cool back and just go with a 15-minute version of the video, then don't click like, and we can definitely keep it nice and short for you on Thursday if that's what you prefer there as well. Whatever you decide, I appreciate you checking out tonight's video. It was a crazy day in the market. Let's see what tomorrow brings and what David has for you in store tomorrow night. But otherwise, I'll plan on seeing you all on Thursday. Take care, everybody. Bye-bye.